Okay. I hear you ask. When is the recession coming? And why does the investor bro have a fail-safe trick to always know when they are coming? Because he predicted the Great Depression after it happened. Well, I'm glad you asked.
Before we begin, if you could do me a favor and like and subscribe, it really helps the channel out because I'm trying to promote non-biased, non-conflict of interest finance, and I want to help to get that through. So if you could subscribe, it helps. Thank you.
So, in order to understand recessions, you first need to understand how economies grow in the first place. See, most economies would normally grow linearly. This is because the only way to scale an economy or business up is increasing your productivity. A lot of countries do this through rising populations to work, for example, having two people to farm bananas instead of just one, increasing the technology to help produce these goods, or selecting for goods that are more efficient given the country's resources. However, humans are impatient. As such, they want good things now rather than when productivity slowly rises. But how do you get the capital to make new investments or purchases now? Well, through debt. Debt essentially allows you to kickstart your productivity. However, you must repay that debt back. Essentially, you are borrowing against your future self. You make more money now, but you will make less money than you make in the future because you have to repay the debt. Well, what happens when you do not have the money to pay for all through this debt? Uncle Sam steps in. Uncle Sam has a vested interest in the economy since it's what gets him elected if he does a good job. As such, when times are hard, Uncle Sam can lower the interest rate. This allows those in debt to get themselves out of such a situation. When the time comes, Sammy can raise the interest rate and encourage these people to get themselves out of debt. However, this causes people to cash out of their assets to pay back their debt. Now, given the rules of supply and demand, the more assets on the market, the less the prices are. That's why the prices of assets such as stocks, real estates, and other financial investments decrease. Now, Uncle Sam does not like this. As such, he lowers the interest rates to help these people borrow back again. And the cycle continues. This works perfectly, right? Wrong. The economic plan that I've just listed forgets one fact: people are stupid. So, what happens when stupidity gets in the economic system? Well, when Uncle Sam lowers the interest rates as stated above, oftentimes people will borrow more money than to just cover their debts. This results in higher debt prices each recession cycle. Most people do not notice this because they are just focused on the insane asset price rises and the cheap cost of money, which makes people stupidly optimistic about the economy. This causes economies to rise faster than productivity in a long period. However, this cannot last forever. Eventually, debt will become so big that Uncle Sam cannot cover it since interest rates are already too low to lower. This is known as a deleveraging. Essentially, it's a recession that Uncle Sam cannot lower interest rates out of. This causes people to have to sell off their assets to provide enough cash to their lenders. Since so many people are selling off their assets at the same time, these prices collapse. However, since prices were artificially high out of this inflated debt cycles, their assets they now have no longer cover the debt they incurred during the economic rise. Essentially, there is no way to get the borrower out of debt. So, how is this unresolvable issue resolved? Well, there are four ways the government can help: cutting spending, reducing the debt burdens of borrowers, redistributing wealth, and inflation. Now, cutting spending is obvious. You spend less, you have more money to repay the lender. However, people, on average, do not like substituting their lobster tails for ramen. Additionally, cutting costs results in deflation. Deflation does not mean that Uncle Sam reverses the printer and starts hoarding dollars, but that people start holding dollars just to repay their lender. This does not just mean ordinary civilians. Companies and even governments can do this. However, this results in higher unemployment, which means less productivity and less income to repay the debt. So the debt burden proportionally gets worse. This means that reducing debt burdens is the next logical step. Lenders, realizing that their loan capital is never going to get returned and that they overextended themselves, are okay with extending the lifetime of the loan or even decreasing how much they need back. Somehow, an agreement is struck that helps reduce the debt burden of the investor. However, this is still inherently deflationary since it just erases existing credit. which erases income. Thus, the dollar still increases in value. Now, since the other two are deflationary, we could just brute force this money and take it from the richest people. Since money is usually distributed unevenly, we can pull from the top to subsidize the bottom. However, many of the rich people's assets have substantially decreased due to these asset falls. Add tax hacks on top of that, and the demand for dollars compared to assets increases in the mind of the rich, which again is deflationary. Deflation can result in capital freeze ups since everyone is trying to hoard their dollars to repay their debt, which means they're not spending it in the market. This just results in lower productivity, higher social tensions, and the probability of Uncle Sam getting voted out of office increasing, which he usually doesn't like. As such, he needs to find a new solution to the deleveraging. So, if everything is deflationary during a deleveraging, what isn't? Well, think inflation. By printing money, Uncle Sam can cover the existing credit with new money. Since the credit has already been in use as money, this inflation is not necessarily going to lead to a price hike, but instead just cover the costs of existing credit. However, when done too much, this can easily spiral out of control and make the demand for money too low, which can lead to many feeling squeezed. As such, Uncle Sam must balance out the deflationary measures above with inflation in order to get himself out of the mess he created. Now, I just gave a long rundown of recessions and deleveragings and all the stuff that causes them, but the bottom line is that when debt and incomes rise faster than productivity, eventually the system will need to correct itself. As such, the tools to figure out when such a crash will come is to notice when asset prices and debt burdens rise far above productivity to the point Uncle Sam can no longer cover it by raising and lowering interest rates. For example, in 2008, housing prices were artificially high since creditors were lending money to borrowers whose income was below the debt. They then packaged these debts as CDOs and sold those debts to investors, who would then collect mortgage payments from said borrowers. They then sold insurance against these CDOs in case they failed, promising repayment to those who own this insurance, or CDSs, even if they did not own the original thing. As such, the result was a lot of agreements and complicated financial web networks that could never be truly fulfilled if enough people stopped paying their loans, which happened. Of course it did, because the people who were receiving loans should have never received loans in the first place. As you see, the high housing prices were artificially high since the demand was already so high for these houses, and it eventually corrected themselves. This network of debt was so high that Uncle Sam had to lower the interest rates to zero to cover the costs of debt, which very rarely happens. How about the Great Depression? Well, it's actually fairly similar. America had just won the Great Never to Happen Again war and was experiencing economic optimism. The wealth of the average person grew, and since investing allowed people to grow their money, they began investing in stock markets. This caused a huge surge in the stock market and encouraged people to borrow money from banks to invest. Banks even did this, investing their own customers' deposits. Yes, they saw nothing wrong with this and invest that money. Now, what happened when productivity slowed down? Eventually, a credit freeze up resulted in a debt burden too high for Uncle Sam to fix it. FDR frequently tried to fix it with no avail. So, what actually ended up getting us out of the crash? An increase in productivity caused by the great Never Again to Happen War Part 2, where we started manufacturing military equipment. What else can cause a disturbance to this debt system? Well, any freeze up of capital and transaction. For example, if I promised to set up a tab at a bar and I never paid, well, the bartender no longer has money he was expecting. Then he loses income, which causes him to buy less. As such, all the stores he would have bought from lose income, which causes them to cut costs, etc., etc. If I do pay back, but inflation rises before I pay, the bartender now has less true income. Do this, but on a bigger scale, and that's how you get economic crashes. So, in summary, there are two types of economic crashes: recessions and deleveragings. Recessions are short term debt cycles that are easily controllable by Uncle Sam raising and lowering interest rates. Deleveragings are when the overextension of SAM lowering interest rates results in too high of debt burdens for people to pay back. As such, SAM must balance out deflationary measures or spending cuts, debt renegotiations, and tax hikes with inflation. This deleveraging results in the economy being exactly where it would be if productivity was the only driving factor. As such, productivity is the best measure of overall economic growth. Thank you so much for watching. Like, sub, comment, empty the dishes because I know you forgot and I got to go do this right now. And peace.